Yeah. Testing.
With innovation that never decays,
Oracle helps customers see data in new ways. The company has evolved beyond software into a cloud, AI, and integrated hardware leader.
howdy y'all, my name is Tanish Meralder.
And my name is Gabriel Mello. We are from Rouse High School near Austin, Texas, home of Oracle.
And today we're presenting our buy recommendation for Oracle Corporation, ticker symbol ORCL, with a price target of $226.95, which represents a 42.2% upside.
Founded in 1977, Oracle has grown into an international technology powerhouse operating across 4 key segments: cloud services and license support encompassing Oracle Cloud Infrastructure, Platform as a Service, and Software as a Service, cloud and on-premise license, which hosts Oracle's comprehensive suite of software tools, hardware, including Oracle's server and storage systems, and services, including consulting and customer support for technological enhancement. With a robust presence in enterprise technology, Oracle is backed by 97% of the Fortune 500 for their cloud computing and database needs, while serving over 430,000 customers in 175 countries.
This has enabled Oracle to outperform the S&P 500 by over 111% over the past 5 years. And we expect this trend to continue, driven by strong growth projections as well as a very reasonable valuation. Beyond past performance, however, Oracle is rapidly expanding in the cloud services and enterprise software market. According to Fortune Insights, the cloud services market is expected to reach a TAM of $5.15 trillion in the next 10 years. This showcases that Oracle is in a very healthy position and rapidly expanding in the cloud and enterprise software market.
Despite only holding 3% of the cloud computing market share, Oracle's cloud infrastructure, or OCI for short, is growing at an impressive 51% year over year, outpacing competitors by double digits. Additionally, according to research done by Morgan Stanley, the on-premise database and software market is expected to grow at 12 to 14% annually, providing another avenue of revenue growth for the company.
This leads us to our investment thesis. While Oracle faces near short-term challenges such as full year 2025's revenue guidance falling short of Wall Street's expectations, as well as heightened capex and FX pressures, we still believe Oracle is severely undervalued. Wall Street has mispriced this stock and has yet to price in several favorable long-term tailwinds, including
OCI's market share potential,
resilience to economic uncertainty,
and innovative development. This leads us to our first key driver, Oracle's long-term positioning for great cloud growth. Yes, Amazon AWS, Microsoft Azure, and Google Cloud currently dominate the space, but Oracle's underdog platform, OCI, is gaining ground fast. What sets OCI apart is its ability to offer lower prices than the competition while also maintaining impressive 44% operating margins. We believe that Wall Street has inaccurately estimated cloud growth to be in the low to mid-teens, which is too conservative. With the rise of AI, more clients need cloud computing than ever before, which will accelerate the transition from hardware-constrained on-premise systems to the more powerful cloud. Cloud operating margins sit at a strong 44% compared to on-premises of just 29%. This means that as demand for cloud increases, Oracle's profits and margins will expand. We believe that the market has underestimated OCI's long-term growth potential, especially as AI and big data continue to drive demand. We think that mid to high teen growth is easily achievable with margin upside to match.
Our second key factor is Oracle's tight product integration and high customer retention rates. Oracle's cloud services and enterprise software market provides a unified ecosystem which streamlines operations and reduces cost. This dual support for both on-premise and cloud compute gives Oracle a unique edge. We believe the market hasn't fully priced in the networking effect of Oracle's cloud services and database software. Even in a scenario where the overall industry growth declines or slows, Oracle is well positioned to retain and grow its market share due to its unified ecosystem as well as the high switching costs associated with fragmented alternatives. Additionally, Oracle's multi-cloud initiative, which features partnerships with all three of the big hyperscalers, enables Oracle's customers to choose their cloud provider. By giving customers more product versatility, Oracle is able to stand on top in customer retention rates as well as have high customer retention rates.
This leads us to our SWOT analysis, which reinforces Oracle's strengths in database management and cloud computing while highlighting clear opportunities to gain market share through OCI. Despite challenges with high capital expenditures and strong competition, Oracle is well poised to stand out thanks to its integrated platform, particularly during periods of market stress.
In addition to these strengths, Oracle is positioned for greater growth and greater profitability. Rising remaining performance obligations driven by government contracts such as Project Stargate could add up to $100 billion in revenue and boost annual revenue growth to 18 to 20%. Additionally, a more aggressive share buybacks and increased dividend growth will not only accelerate EPS growth, but will also lead to long-term stock appreciation.
This leads us to our third key driver, Oracle's strategic capital management and innovative development. Management has committed themselves to innovative development through building out data and cloud infrastructure despite high upfront costs. This positions the company for long-term revenue growth and high ROI, which is supported by our DuPont analysis showcasing Oracle's strong return on equity and financials. Moreover, management has committed themselves to delivering shareholder value, especially through increasing share buybacks and rising dividend payouts, emphasized by the doubling of the dividend last quarter.
When taking a deeper look at financials, we see that Oracle reported a gross profit margin of 71% last quarter. However, we believe this number will go up 80% as CapEx levels normalizes. While recent R&D investments have put heightened pressure on free cash flow yield, Oracle still boasts a healthy 2.85% free cash flow yield, and we only see this to rise as we see the shift from on-premise to higher margin OCI. Taking a look at balance sheets, we see that Oracle has over $140 billion in assets as well as a BBB credit rating. Paired with low-cost debt and ample liquidity, Oracle is able to weather out any economic and industry uncertainties. Thanks to strong tailwinds as well as really good financials, we project Oracle to grow at a 15% CAGR over the next 5 years.
To ensure that Oracle was trading at a reasonable valuation, we conducted a 10-year discounted cash flow analysis modeled with 3 distinct growth case scenarios. Each scenario is assigned different rates and probabilities to arrive at a more accurate intrinsic price. Our bear case assumes a slower transition from on-premise to cloud with persistent capital expenditures leading to a CAGR of 9.8%. Our base case is assigned the highest probability and assumes a strong adoption of OCI along with strategic capital management that leads to operational efficiency, resulting in a CAGR of 11.8%. Our bull case assumes accelerated adoption of OCI and a dominant capture of market share from hyperscalers, leading to a CAGR of 13.3%. Weighing these scenarios together, we arrived at an intrinsic price of $226, representing a 42.2% upside from current levels.
Additionally, we used very conservative inputs and assumptions to ensure the robustness and accuracy of our final recommendation. Furthermore, we looked at our WACC sensitivity analysis table to ensure that our final price target was within a very reasonable range.
To build the robustness of our final recommendation, we identified some investment risks and developed some feasible mitigants to address them. First, when examining the cloud computing market, it is highly competitive, dominated by the big 3 hyperscalers. However, Oracle's integrated platform and low-cost pricing structure allow it to stand out amongst the rest.
Additionally, another issue could be supply chain issues with Oracle sourcing NVIDIA GPUs for its data centers. However, just this past week, Oracle announced a $40 billion deal to buy AMD and NVIDIA GPUs. This highlights that special partnerships and allocations can be done to avoid any hardware constraints.
Another risk is the high capital expenditure costs that Oracle have been taking up front. We believe that investors must aptly realize that these capital investment will lead to greater operational efficiency in the future.
Lastly, the United States is currently facing a strong dollar, which is impacting Oracle's margins negatively by 50 basis points on a constant currency basis. However, we only believe this is a short-term risk, and in the meantime, Oracle can employ future pricing contracts to hedge this risk.
Beyond financial metrics, it's important to note that Oracle is a key leader in social impact. For example, 81% of Oracle Cloud runs on renewable energy and 47% of company emissions have seen a reduction since 2020. Additionally, Oracle empowers and supports global tech education through initiatives in Africa and India, showcasing their positive institutional impact. Lastly, Oracle engages in strong corporate oversight rooted in performance-based executive compensation. The company aptly aligns accountability with investor interest.
As we cross the finish line, we want you to remember that Oracle is no longer just a legacy software company. It's a rapidly evolving cloud powerhouse.
With OCI's explosive growth, high margin recurring revenue, and deeply undervalued stock price, we firmly recommend to buy Oracle at a target price of $226, representing a 42.2% upside from current levels.
Driving innovative technologies,
Oracle unlocks endless possibilities. Thank you.
Opening the floor to any questions.
It looked like in the cloud business, they're perhaps competing on price by, pricing their offering competitively. I guess, what do you think the risk is of competition matching their pricing if they start getting too big and then it's just kind of a race to the bottom for everyone?
I feel like with competition matching pricing, it's going to be very hard for either AWS or cloud to be able to go that low of a price and still maintain high revenue and profit. And even if, for example, there was a situation where they were able to match price, what Oracle offers is an integrated ecosystem. Right? All customers can keep their data on one database. They don't have to switch around. If you're an AWS client, for example, or an Azure client, you'd have to switch databases. You can't keep it all in one place. The conveniency of Oracle is going to keep customers and enterprises coming back no matter the price.
Additionally, another competitive advantage Oracle has is it's able to cater to all sizes of customers. When we take a look at hyperscalers, they only go for the big clients, and then they build really big databases and cloud compute structures. However, Oracle can target emerging markets, which it's doing really well, and build custom-sized racks that are really small and efficient, and target more customers and gain more market share in that aspect, which the other hyperscalers aren't doing.
You painted a very bright picture of the company, but we see that gross income, let's see, my eyes aren't that good. Not up very much this year. The EPS growth fell, or is projected to fall in 2025. On an earlier slide, you showed that their share buybacks were pretty low last 3 years. Is everything really as rosy as you guys say?
Yes, the reason why EPS and share buybacks have actually gone down is mainly because Oracle's positioning for capital expenditures. They believe that they can get a higher internal profit margin by reinvesting into the company rather than creating shareholder value through share buybacks instantly. We're not saying that Oracle just forgot about share buybacks. We're just saying that the company is focusing where they should put their money to work and how they can actually bring that to reality through greater returns. And they believe that capital expenditures are going to generate a greater amount of free cash flow and profits later on.